The long-term irreversible trends I've discussed in detail in my upcoming book, $10,000 Gold, continue to develop. Many of the trends, such as debt creation and the movement away from the US dollar, are accelerating, and their consequences are appearing globally. Today we'll interpret how these developments will likely affect the price of gold over the coming year and beyond. Perhaps the most prevalent indication that something is amiss with the world's economy is a sense of malaise that many have been experiencing, a distrust in the financial system and the government. A U.S. Gallup poll compiled at the end of November 2012 found politicians to be the second least trusted individuals in society, next to used car salesmen. Sharing bottom marks were bankers, journalists, business executives, state governors, and insurance salespeople. By contrast, nurses were the most trusted. This level of distrust is global. Ask any Greek what he or she thinks of the bankers and politicians who, through their complex bond deals, have destroyed the country's economy. Ask the people of Iceland, who ignored the bankers' demands for more money and instead threw them in jail. Such distrust is a tangible indication that the 41-year-old experiment in a global fiat currency system is starting to fail. At this stage, it is no surprise to see that those who benefited from the system are stepping up their PR campaign. Their goal is to bolster trust in paper currencies. Such campaigns are broad-based. As Jim Rickards, author of Currency Wars, pointed out, the world is in the midst of an economic war between countries, currencies, and gold. Developing countries are challenging the US dollar's de facto reserve currency status, and many in the East are turning to physical gold. The Western financial media insist on supporting the status quo with their positive messages of imminent economic recovery. But many are not buying it, and the global appetite for physical bullion is the best indication of this. It should come as no surprise that the US petrodollar is facing challenges. Reserve currencies go through cycles that last about a century, as can be seen from the reserve currency chart. They usually end when the country that has this exalted privilege creates too much currency and goes too deeply into debt, just as the US is demonstrating. As in any war, truth is the first casualty. But how do we distill the truth from so much complex and contradictory financial information? The answer is simple: by changing perspective, by using gold as our measure for financial assessment. The gold vantage point is more comprehensive. It allows us to see the hidden influences of inflation, for example. It helps us to understand why governments are doing what they are doing, despite their words to the contrary. The fiat experiment officially began on August 15, 1971, the day President Nixon broke the US dollar's final international peg to gold. This allowed governments to create unrestricted amounts of currency with none of the safeguards that gold backing otherwise provided. Consequently, the debt now is so large that it is impossible to pay back. In the words of Congressman Ron Paul, the United States is technically bankrupt. So let's start by looking at the most important influences on the price of gold: global government debt. Government debt creation through currency debasement causes paper currencies to lose purchasing power against the more stable economic standard of gold. In fact, there is a direct relationship between the debt and the price of gold. The relationship to gold and the U.S. debt chart, which was the centerpiece of last year's outlook for gold, shows the gold price rising in near lockstep with rising U.S. debt over the past decade. The increase in central bank assets is a good indicator of how this debt is growing. Between 2007 and 2012, the Bank of England reserves increased by 362%, and the U.S. Fed's increased by 223%. Unfortunately, as the people of Greece have discovered, most of the bailout cash stays in the hands of the bank. even though the taxpayer is expected to repay the lenders. Although all the major currencies have lost purchasing power against gold, the chart shows the dramatic demise of the US dollar. Being the world's de facto reserve currency, it is by far the largest and most important, and the reason we give so much attention to the financial health of our southern neighbor. We can see that while backed with gold, the US dollar maintained purchasing power. In 1934, it lost its domestic peg to gold, and in 1971, its international peg. The dollar has now lost 98% of its purchasing power since 1934. The U.S. federal debt is now growing exponentially. In his first term, President Obama added more debt than was added since the United States declared its independence from Britain in 1776. Another milestone, in Obama's first term, the U.S. debt to GDP ratio passed 100%. At the present time, U.S. national debt is $16.4 trillion and GDP is $15.5 trillion. Interest payments on the debt were $454 billion in 2011. The U.S. Treasury's balance sheet does not include the unfunded liabilities of Medicare, Social Security, and other outside and very real obligations. The actual liabilities of the federal government, including Social Security, Medicare, and federal employees' future retirement benefits, already exceed $86 trillion, or 550% of GDP. These figures are kept from the public eye and are not listed on the official balance sheets. They can be found in obscure documents like the annual Medicare Trustees Report. Some estimates put total unfunded liabilities at well over $200 trillion. In 1984, in what might have been the last serious attempt of the U.S. government to address the problem of rising debt, President Reagan's Grace Commission report stated that with 2/3 of everyone's personal income taxes wasted on government excesses or not collected because of the underground economy, 100% of what is collected is absorbed solely by interest on federal debt and by federal government contributions to transfer payments. In other words, all individual income tax revenues are gone before one nickel is spent on services which taxpayers expect from their government. It is safe to say that most of this 1984 report warned against that trillion-dollar debts would become a reality if action was not taken immediately, has now become a reality. To address the issue of runaway debt, politicians have 5 choices. Grow out of it through increased productivity and increased exports. This is highly unlikely as Western economies and even China are poised for recession. Introduce strict austerity measures to reduce spending. This has the unwanted short-term effect of increased unemployment, lower tax revenues, reduced GDP, and results in even higher deficits. The voting public hates it, and the U.S. government has shown no willingness to take this path. Default on the debt. This will make it difficult to raise future bond issues at any reasonable level of interest rates. Issue even more debt and have the central bank in question simply create whatever amount of currency is required. Follow a program of financial repression. The 4 main pillars of financial repression are negative real interest rates and interest rate caps through suppression of CPI, nationalization of industry, strict government control over investment criteria, capital controls, and lending practices, and currency debasement through unrestricted debt creation. Obviously, governments around the world have chosen to fight this currency war and are ballooning debt with options 4 and 5. The fiscal cliff fiasco of December 2012 proved that the majority of U.S. politicians will not risk their careers by implementing the more direct, more responsible option 2 or 3.